Welcome to this exam review from Birdsy, your AI-powered study partner. Be sure to like and subscribe for more exam prep videos. Let's get started.
Under the Truth in Lending Act, what triggers the requirement for additional disclosures in advertising? Is it A, any mention of a loan, B, specific credit terms like interest rate, C, the name of the lender, or D, the duration of the loan? The answer is B, specific credit terms like interest rate. Trigger terms in advertising, such as specific credit terms, require additional disclosures to ensure consumers are fully informed about the credit offer. Which of the following does not trigger additional disclosure obligations under TILA when included in an advertisement? Is it A, the amount of down payment, B, the amount of any payment, C, the number of payments, or D, general statement about credit availability? The answer is D, general statement about credit availability. Why this question may seem a bit tricky. It tests understanding of what constitutes a trigger term. General statements about credit availability do not require additional disclosures. A real estate agent advertises a property with low monthly payments without specifying the amount. What disclosure obligations arise under TILA? Is it A, full disclosure of all loan terms is required, B, disclosure of interest rate is required, C, no additional disclosures are required, or D, disclosure of down payment is required? The answer is C, no additional disclosures are required. The phrase low monthly payments is vague and does not specify an amount. Thus, it does not trigger additional disclosures under TILA. What is a trigger term under the Real Estate Settlement Procedures Act? Is it A, specific financial terms like interest rates, B, the real estate agent's contact information, C, the location of the property, or D, the type of property being sold? The answer is A, specific financial terms like interest rates. Trigger terms under RESPA include specific financial terms that require additional disclosures to ensure transparency in real estate transactions. A lender advertises a mortgage with 5% interest rate for the first year. What must be disclosed under TILA? Is it A, only the interest rate must be disclosed, B, APR and terms of repayment must be disclosed, C, no additional disclosures are needed, or D, a lender's contact information must be disclosed? The answer is B, APR and terms of repayment must be disclosed. Stating an interest rate triggers the need for additional disclosures, including the APR and terms of repayment, to provide full transparency. Under the Truth in Lending Act, which of the following terms in an advertisement requires additional disclosures? Is it A, the color of the house, B, the amount of down payment, C, the number of bedrooms, or D, the neighborhood name? The answer is B, the amount of down payment. TILA requires additional disclosures when specific credit terms, such as the amount of down payment, are mentioned in advertisements. Which statement about trigger terms in advertising under TILA is correct? Is it A, mentioning any interest rate always requires full disclosure of all loan terms, B, advertising no closing costs never requires additional disclosures, C, stating the monthly payment amount requires additional disclosures, or D, using the term affordable in ads requires full disclosure of loan terms? The answer is C, stating the monthly payment amount requires additional disclosures. Why this question may seem a bit tricky. The statement about interest rate is misleading because it requires additional disclosures only when specific terms are mentioned.
Notice the code in the corner. When you're stumped by a question, enter it at birdsy.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
A lender advertises a mortgage with no down payment required. What must be disclosed under TILA? Is it A, the annual percentage rate, B, the number of bedrooms in the property, C, the property's square footage, or D, the neighborhood crime rate? The answer is A, the annual percentage rate. The phrase "no down payment required" is a trigger term necessitating disclosure of terms like the annual percentage rate. Which of the following is a trigger term under the Real Estate Settlement Procedures Act? Is it A, the interest rate, B, the loan term, C, the down payment percentage, or D, the cost of settlement services? The answer is D, the cost of settlement services. RESPA focuses on settlement services and costs, not specific credit terms like TILA. A real estate agent advertises a property with special financing available. What disclosure obligations arise under TILA? Is it A, no additional disclosures are required, B, disclose the terms of the financing, including APR, C, only disclose the interest rate, or D, disclose the property's appraisal value? The answer is B, disclose the terms of the financing, including APR. The phrase "special financing available" implies specific credit terms, triggering the need for additional disclosures under TILA. Which type of loan is exempt from the disclosure requirements under the Truth in Lending Act? Is it A, home equity lines of credit, B, business loans, C, reverse mortgages, or D, student loans? The answer is B, business loans. Loans primarily for business, commercial, or agricultural purposes are exempt from TILA disclosure requirements. Under RESPA, which of the following loan types is not exempt from its regulations? Is it A, loans secured by residential real estate, B, loans for business purposes, C, temporary loans, or D, vacant land loans? The answer is A, loans secured by residential real estate. Why this question may seem a bit tricky. RESPA applies to federally related mortgage loans, which include loans secured by residential real estate. John is applying for a loan to purchase a farm where he plans to grow crops for sale. Under which regulation would this loan be exempt from disclosure requirements? Is it A, RESPA, B, HOEPA, C, TILA, or D, none of the above? The answer is C, TILA. Loans for agricultural purposes are exempt from TILA disclosure requirements as they are not considered consumer credit transactions.
Finding this exam review helpful? If you haven't already, like and subscribe for more videos that'll get you ready to pass.
Which of the following is a characteristic of a loan exempt from HOEPA regulations? Is it A, a loan with a high interest rate, B, a loan secured by a primary residence, C, a loan for home improvement, or D, a loan for business purposes? The answer is D, a loan for business purposes. Loans primarily for business, commercial, or agricultural purposes are exempt from HOEPA regulations. Emily is taking a loan to purchase a new office building for her expanding business. Which regulations disclosure requirements will not apply to her loan? Is it A, RESPA, B, TILA, C, HOEPA, or D, all of the above? The answer is B, TILA. Business purpose loans are exempt from TILA disclosure requirements as they are not considered consumer credit transactions. Which type of loan is exempt from the Home Ownership and Equity Protection Act regulations? Is it A, home equity loans, B, purchase money mortgages, C, business purpose loans, or D, reverse mortgages? The answer is C, business purpose loans. Loans for business purposes are exempt from HOEPA regulations, which are designed to protect consumers in home equity lending. Sarah is taking out a loan to buy a small apartment building where she will live in one unit and rent out the others. Under which regulation might this loan be exempt from disclosure requirements? Is it A, RESPA, B, TILA, C, HOEPA, or D, none of these? The answer is B, TILA. Loans primarily for business purposes, like rental properties, are often exempt from TILA disclosure requirements. What is included in the calculation of points and fees for qualified mortgage compliance? Is it A, loan originator compensation, B, property taxes, C, homeowner's insurance, or D, escrow deposits? The answer is A, loan originator compensation. Points and fees include finance charges, loan originator compensation, and real estate-related fees, among others. These are critical for determining QM status. Which of the following is not considered when calculating points and fees for a qualified mortgage? Is it A, loan originator compensation, B, title insurance, C, prepaid interest, or D, credit life insurance premiums? The answer is B, title insurance. Why this question may seem a bit tricky. It's easy to assume all fees related to the loan are included, but certain fees, like title insurance, are excluded. John is applying for a mortgage and his lender is calculating points and fees. Which fee should be excluded to ensure compliance with QM standards? Is it A, loan origination fee, B, appraisal fee, C, title insurance, or D, credit report fee? The answer is C, title insurance. Title insurance is excluded from the points and fees calculation, ensuring compliance with QM standards. How are points and fees calculated for a qualified mortgage? Is it A, only finance charges, B, only loan originator compensation, C, only real estate-related fees, or D, finance charges, loan originator compensation, and certain other fees? The answer is D, finance charges, loan originator compensation, and certain other fees. Points and fees are calculated by adding up all finance charges, loan originator compensation, and certain other fees. Sarah is reviewing her mortgage documents and notices a fee for a credit report. Should this be included in the points and fees calculation for QM compliance? Is it A, yes, it should be included, B, no, it should not be included, C, only if it exceeds a certain amount, or D, only if it's paid up front? The answer is A, yes, it should be included. Credit report fees are included in the points and fees calculation for QM compliance. What is the maximum percentage of points and fees allowed for a qualified mortgage on a loan amount of $100,000? Is it A, 3%, B, 5%, C, 7%, or D, 10%? The answer is B, 5%. For a loan amount of $100,000, the maximum allowable points and fees for a qualified mortgage is 5% of the total loan amount. Which of the following is included in the calculation of points and fees for a qualified mortgage? Is it A, title insurance fees, B, escrow account deposits, C, loan originator compensation, or D, appraisal fees? The answer is C, loan originator compensation. Why this question may seem a bit tricky. Some fees, like those for title insurance, are often misunderstood. However, only fees paid to the lender or affiliates are included. Emily is finalizing her mortgage and notices a fee for a required flood certification. Should this fee be included in the points and fees calculation for QM compliance? Is it A, yes, because all third-party fees are included? B, yes, because it is a required fee? C, no, because it's a government fee? Or D, no, because it is typically excluded unless paid to the lender or an affiliate? The answer is D, no, because it is typically excluded unless paid to the lender or an affiliate. SLUD certification fees are typically excluded from the points and fees calculation unless paid to the lender or an affiliate. Under HOEPA, what is the maximum percentage of points and fees allowed for a loan to be considered a high-cost mortgage? Is it A, 3%, B, 5%, C, 8%, or D, 10%? The answer is B, 5%. HOEPA defines a high-cost mortgage as one where points and fees exceed 5% of the total loan amount for loans equal to or greater than $22,052. Which of the following fees is not included when calculating the points and fees threshold under HOEPA? Is it A, credit insurance premiums, B, loan origination fees, C, bona fide third-party charges, or D, prepayment penalties? The answer is C, bona fide third-party charges. Why this question may seem a bit tricky. Some fees, like bona fide third-party charges, are excluded from the HOEPA calculation, but others, like credit insurance premiums, are included. A borrower in California is considering a loan with points and fees totaling 6% of the loan amount. Under state law, what is the maximum percentage of points and fees allowed for a loan to avoid being classified as high cost? Is it A, 6%, B, 5%, C, 7%, or D, 8%? The answer is A, 6%. California's high-cost loan threshold is set at 6% of the total loan amount, aligning with federal standards for loans above a certain amount. A lender offers a loan with a 7% interest rate and 4% in points and fees. What determines if this loan is considered high cost under HOEPA? Is it A, only the interest rate, B, only the points and fees, C, neither interest rate nor points and fees, or D, both interest rate and points and fees? The answer is D, both interest rate and points and fees. Why this question may seem a bit tricky. Both the interest rate and points and fees must be considered, but the points and fees threshold is key for HOEPA classification. John is applying for a mortgage in a state with a high-cost loan threshold of 5% for points and fees. His loan amount is $200,000, and the lender charges $12,000 in points and fees. Is this loan considered high cost? Is it A, no, because the fees are below 10%, B, no, because the fees are below 7%, C, yes, because the fees exceed 5%, or D, yes, because the fees exceed 3%? The answer is C, yes, because the fees exceed 5%. The points and fees total $12,000, which is 6% of the $200,000 loan amount, exceeding the 5% threshold, thus classifying it as high cost. Under HOEPA, what is the maximum percentage of points and fees allowed for a loan to be considered a high-cost mortgage? Is it A, 3%, B, 5%, C, 7%, or D, 10%? The answer is B, 5%. HOEPA defines a high-cost mortgage as one where points and fees exceed 5% of the total loan amount for loans above $22,052 or 8% for smaller loans.
Notice the code in the corner? When you're stumped by a question, enter it at birdsy.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
What is a zero-tolerance item in the context of loan disclosures? Is it A, lender fees, B, homeowners insurance premiums, C, title insurance fees, or D, prepaid interest? The answer is A, lender fees. Zero-tolerance items are costs that cannot change from the initial loan estimate to the closing disclosure. These include lender fees and transfer taxes. Which of the following costs can change without limit between the loan estimate and the closing disclosure? Is it A, lender fees, B, transfer taxes, C, homeowners insurance premiums, or D, recording fees? The answer is C, homeowners insurance premiums. Why this question may seem a bit tricky, it involves understanding which costs are not subject to tolerance limits, such as homeowners insurance premiums. During a loan closing, John notices that the recording fees have increased by 12% from the loan estimate. What should be the lender's response? Is it A, ignore the increase as it is permissible, B, cover the excess amount over the 10% tolerance, C, reissue the loan estimate with the new fees, or D, charge John the additional amount? The answer is B, cover the excess amount over the 10% tolerance. Recording fees are subject to a 10% tolerance limit. If they exceed this, the lender must cover the excess amount. Sarah is reviewing her closing disclosure and notices that the lender fees have increased from the loan estimate. What should she expect regarding these fees? Is it A, the fees are allowed to increase by up to 10%, B, the fees can increase if the lender provides a valid reason, C, the fees can increase if Sarah agrees to the change, or D, the lender must absorb any increase in these fees? The answer is D, the lender must absorb any increase in these fees. Lender fees are zero-tolerance items, meaning they cannot increase from the loan estimate to the closing disclosure. What is a key characteristic of a high-priced mortgage loan? Is it A, it has a fixed interest rate, B, its APR exceeds the average prime offer rate by a certain percentage, C, it requires a down payment of at least 20%, or D, it is only available for first-time homebuyers? The answer is B, its APR exceeds the average prime offer rate by a certain percentage. An HPML is defined by its APR exceeding the average prime offer rate by a specified percentage depending on the loan type. Which of the following is true about the safe harbor provision for HPMLs? Is it A, it guarantees the loan will never face legal challenges, B, it applies to all mortgage loans automatically, C, it provides legal protection if the loan meets certain criteria, or D, it is only applicable to non-traditional loans? The answer is C, it provides legal protection if the loan meets certain criteria. Why this question may seem a bit tricky, safe harbor provides legal protection if the loan meets certain criteria, but it doesn't guarantee the loan is free from all legal challenges. John is considering a mortgage with an APR that is 2% above the average prime offer rate. What type of loan is this likely to be? Is it A, high-priced mortgage loan, B, conventional loan, C, FHA loan, or D, jumbo loan? The answer is A, high-priced mortgage loan. This scenario describes a loan with an APR exceeding the average prime offer rate by a significant margin, characteristic of an HPML. What does the rebuttable presumption rule imply for HPMLs? Is it A, the loan is automatically considered compliant, B, the borrower cannot challenge the loan terms, C, the loan is exempt from all legal scrutiny, or D, the lender is presumed compliant unless proven otherwise? The answer is D, A lender is presumed compliant unless proven otherwise. Rebuttable presumption means the lender is presumed to have complied with ability to repay requirements unless proven otherwise. Sarah's mortgage lender claims safe harbor protection for her HPML. What must be true for this claim to be valid? Is it A, the loan has a fixed interest rate? B, the loan meets ability to repay requirements? C, the loan is for a primary residence? Or D, the loan has a term of 30 years? The answer is B, the loan meets ability to repay requirements. For safe harbor protection, the loan must meet specific criteria, such as adhering to ability to repay rules. What is a defining feature of a high-priced mortgage loan under federal regulations? Is it A, it requires no down payment? B, its APR exceeds the average prime offer rate by a certain percentage? C, it is only available for first-time homebuyers? Or D, it offers a fixed interest rate for the life of the loan? The answer is B. Its APR exceeds the average prime offer rate by a certain percentage. An HPML is characterized by having an APR that exceeds the average prime offer rate by a specified percentage, depending on the loan type. Lisa's lender claims safe harbor protection for her HPML, but she believes the loan terms are unfair. What must Lisa demonstrate to challenge this protection? Is it A, the loan has a higher interest rate than advertised? B, the lender did not provide a copy of the appraisal? C, the lender failed to verify her ability to repay the loan? Or D, the loan was not insured by a federal agency? The answer is C. The lender failed to verify her ability to repay the loan. Lisa must show that the lender did not comply with the ability to repay rule, which is necessary to challenge safe harbor protection. Which of the following loan terms is prohibited under HOEPA Section 32? Is it A, interest-only payments? B, balloon payments for loans under 5 years? C, adjustable interest rates? Or D, prepayment penalties? The answer is B, balloon payments for loans under 5 years. HOEPA Section 32 prohibits balloon payments for loans with terms of less than 5 years, among other restrictions. Under HOEPA Section 32, which disclosure must be provided to the borrower at least 3 days before closing? Is it A, truth in lending disclosure? B, good faith estimate? C, HOEPA disclosure? Or D, loan estimate? The answer is C, HOEPA disclosure. Why this question may seem a bit tricky. The requirement is specific to the HOEPA disclosure, which includes the APR, payment schedule, and other loan terms, not just any general disclosure. A borrower is applying for a high-cost mortgage under HOEPA Section 32 and is required to receive counseling. What must the lender ensure before proceeding? Is it A, the borrower receives counseling from a HUD-approved counselor? B, the borrower signs a waiver to skip counseling? C, the borrower receives counseling from any financial advisor? Or D, the borrower completes an online financial literacy course? The answer is A, the borrower receives counseling from a HUD-approved counselor. The lender must ensure that the borrower receives counseling from a HUD-approved counselor before the loan is finalized. What is a key requirement for a loan to be considered a high-cost mortgage under HOEPA Section 32? Is it A, the loan has a fixed interest rate? B, the loan term is less than 15 years? C, the loan is for a primary residence? Or D, the loan exceeds certain APR or fee thresholds? The answer is D. The loan exceeds certain APR or fee thresholds. A loan is considered high cost if it meets certain APR thresholds or has excessive points and fees. A lender is reviewing a loan application that might fall under HOEPA Section 32. What must the lender provide to the borrower to comply with disclosure requirements? Is it A, a copy of the borrower's credit report, B, a HOEPA disclosure with APR and payment schedule, C, a list of all potential fees associated with the loan, or D, a summary of the lender's underwriting criteria? The answer is B, a HOEPA disclosure with APR and payment schedule. The lender must provide a HOEPA disclosure detailing the APR, payment schedule, and other terms at least 3 days before closing. Under the Dodd-Frank Act, which feature is not typically associated with non-traditional loans? Is it A, interest-only payments, B, balloon payments, C, fixed-rate payments, or D, negative amortization? The answer is C, fixed-rate payments. Non-traditional loans often include features like interest-only payments, balloon payments, and negative amortization. Fixed-rate payments are not typically associated with non-traditional loans. Which underwriting requirement is mandated by the Dodd-Frank Act for non-traditional loans? Is it A, providing a fixed interest rate, B, verifying the borrower's ability to repay, C, offering a no documentation loan option, or D, ensuring the loan has a balloon payment? The answer is B, verifying the borrower's ability to repay. Why this question may seem a bit tricky, the Dodd-Frank Act requires lenders to verify a borrower's ability to repay, which can be confused with simply checking credit scores or income levels. John is considering a loan with a balloon payment feature. What must the lender do under the Dodd-Frank Act before approving this loan? Is it A, verify John's ability to repay the loan, including the balloon payment, B, offer John a lower interest rate to offset the balloon payment, C, provide John with a fixed interest rate for the loan term, or D, ensure John has a cosigner for the loan? The answer is A, verify John's ability to repay the loan, including the balloon payment. The lender must verify John's ability to repay the loan, including the balloon payment, to comply with the Dodd-Frank Act's requirements.
Finding this exam review helpful? If you haven't already, like and subscribe for more videos that'll get you ready to pass.
What is one of the primary roles of the Consumer Financial Protection Bureau? Is it A, enforcing federal consumer financial laws, B, setting interest rates for banks, C, issuing currency, or D, regulating stock markets? The answer is A, enforcing federal consumer financial laws. The CFPB is responsible for enforcing federal consumer financial laws and ensuring that consumers are treated fairly by banks, lenders, and other financial institutions. Which agency is primarily responsible for the oversight of disclosures in mortgage lending? Is it A, Federal Reserve, B, Consumer Financial Protection Bureau, C, Federal Deposit Insurance Corporation, or D, Office of the Comptroller of the Currency? The answer is B, Consumer Financial Protection Bureau. Why this question may seem a bit tricky. While multiple agencies have roles in financial regulation, the CFPB specifically oversees disclosures to ensure transparency in mortgage lending. A mortgage lender fails to provide the required disclosure documents to a borrower within the specified timeframe. What action can the CFPB take in this situation? Is it A, revoking the lender's license, B, issuing a warning letter, C, imposing financial penalties, or D, suspending all lending activities? The answer is C, imposing financial penalties. The CFPB can impose penalties on lenders who fail to comply with disclosure requirements, ensuring that consumers receive necessary information in a timely manner. Which of the following is a penalty the CFPB can impose for non-compliance with financial regulations? Is it A, incarceration of executives, B, revocation of citizenship, C. public shaming, or D. financial fines? The answer is D. Financial fines. The CFPB can impose fines on institutions that violate consumer financial protection laws, ensuring compliance and protecting consumers. A financial institution is found to have inadequate record-keeping practices during a CFPB audit. What is a likely consequence? Is it A. requirement to enhance record-keeping practices, B. immediate closure of the institution, C. reduction in interest rates offered, or D. mandatory executive resignations? The answer is A. requirement to enhance record-keeping practices. The CFPB can require the institution to improve its record-keeping practices and may impose penalties to ensure compliance. What is the primary purpose of state laws adding extra layers to federal requirements in the context of administration and enforcement? Is it A. to override federal laws entirely, B. to address local concerns and enhance consumer protection, C. to simplify the regulatory framework, or D. to ensure uniformity across all states? The answer is B. to address local concerns and enhance consumer protection. State laws often add extra layers to federal requirements to address specific local concerns, enhance consumer protection, or fill gaps not covered by federal law. When a state law adds extra requirements to a federal regulation, which of the following is true? Is it A. the state law automatically overrides the federal law, B. the federal law becomes void in that state, C. the state law can add requirements as long as it doesn't conflict with federal law, or D. the state law must be identical to the federal law? The answer is C. The state law can add requirements as long as it doesn't conflict with federal law. Why this question may seem a bit tricky. It tests understanding of the relationship between state and federal laws. State laws can add requirements, but cannot conflict with federal laws. A mortgage lender in California must comply with both federal regulations and additional state-specific requirements. What's the most likely reason for these state-specific requirements? Is it A. to address unique state concerns and enhance consumer protection, B. to reduce the complexity of federal regulations, C. to ensure federal regulations are not applicable, or D. to create uniformity with other states? The answer is A. to address unique state concerns and enhance consumer protection. California often implements stricter regulations to address unique state concerns and enhance consumer protection beyond federal standards.
Thanks for watching. If you found this exam review helpful, be sure to subscribe for more real-world practice and topic-focused study videos. And visit Birdsy.ai to start your free trial of Birdsy, your AI-powered study partner.